Really important to us. I mean, we've paid 22 consecutive dividends, this being our 22nd. That's delivered 1.2 billion, close to $1.2 billion back to shareholders. And we think it's a really important part of our strategy and a gold company's attractiveness to investors, that we can make money off every ounce of gold that we produced. And I think this last 6 months result is an indicator of where Evolution is going. Our cash generation is building momentum. Our capital intensity is reducing. And in Australian dollars, the gold price is still very high at over 3,000 Australian dollars an ounce. So we see that building and we see that becoming better as we deliver into our guidance for FY24.
And considering what we've seen from the RBA, that discrepancy in terms of the Australian pricing might get a little bit more large. But I've got to ask you, because obviously you've been incredibly busy on the M&A front, if we're talking about North Peaks, if we're talking about just in general. Is there a point that you've reached now? Now, I've asked you this before, but is there a point that you've reached now in terms of now just consolidating and integrating all of your assets? Or are you still thinking with an acquisitive mind? Because, you know, there's been a lot of consolidation in the gold miner space of late, and I would have to imagine you might be forced into that situation just to keep up.
Look, we've heard loud and clear from investors that they want us to digest what we've acquired. We bought a very significant asset in North Parkes in December. We don't choose the timing when these assets are up for sale. We've been interested in this asset for over 3 years. We looked at it in 2020. We've been engaged in conversations since February last year and finally secured the asset in December. But recognizing that it wasn't a great timing from an investor perspective, we've engaged with them. We've heard loud and clear that they want us to really digest what we have, demonstrate this improved cash generation, not just for the last 6 months, but going forward, increase returns to shareholders, and earn the right to grow again. So I would say that calendar year 2024, you can expect us to be focusing on delivery, predictability, rather than on acquisitions.
Can I just ask you about your cost base as well? Because obviously every business is right now dealing with the fact that the rates profile might be increasing and could continue to increase potentially in terms of, you know, what the cost of capital is going to be. But I would imagine that with these new assets, that comes along with it, the capex required. In terms of your balance sheet right now, are you having to think about potentially raising fresh capital in order to build out the projects, or is your balance sheet as such and your free cash flow as such that you won't necessarily have to go down that route?
So a couple of things. The first thing I'd mention is that 75% of our debt is actually fixed price debt. So our total cost of debt is 4.99%. But most of it is fixed, and we did that under US private bond placements over the last couple of years. So very comfortable that our cost of debt is low. Very comfortable that the acquisitions we've made are cash generative and not cash consuming, and also pleased that we are entering a period of lower capital intensity across our portfolio. So we're looking to de-gear our balance sheets, certainly not looking at raising additional equity or debt, rather looking to get more liquidity on the balance sheet. It's currently $720 million, so which is very good available liquidity, but looking to get that cash generation increasing, bank every ounce of gold at a higher gold, and the copper is being exposed to a higher copper price. So looking at cash generation rather than any sort of capital raisings.